Welcome back to the Options Academy. In this presentation, we'll continue to explore the butterfly's strategies, and this time we'll take a look at the directional long butterfly. While the iron butterfly carries the potential for a substantial loss to the option buyer, the directional long butterfly holds an extremely attractive risk-reward profile. In fact, as in any other options buying strategy, the risk of the butterfly prior to expiration is always limited to the premium a trader pays when constructing the trade. If you've ever been to a zoo, you know that most people love seeing the tigers, but usually pass up the butterfly exhibit. But if you had your choice, which cage would you walk into? Right? You're a lot less likely to get eaten by butterflies. The directional butterfly can be a very useful strategy for a trader who anticipates a move in one direction or another, should the market trade in a specific range. This is so very important to understand. The long butterfly is a strategy that aims to identify a specific range in which the market will expire. Above this range or below it, the trade would yield to no gains. Here's how it works. Like the short iron butterfly, the long directional butterfly also consists of 4 options, of which 2 are long and 2 are short. The structure is different here in that all options are either calls or puts. The options may be placed above the current market level, below it, or partly in the money, at the money, and out of the money. But it will always consist of 4 calls or 4 puts. You can see an illustration of the long butterfly in the written article matching this presentation on our site, theoptionsacademy.com. In the illustration, we are assuming that the market is trading at the 1,000 level. And a trader who wants to take a position assuming a bullish trend buys one 1025 call option, sells 2 1050 call options, and again buys one 1075 call. Let's look at the risk profile. The premiums, or 2 wings combined, the 1025 and the 1075, will cost slightly more than the premiums of 2 center options combined, the 2 1050 calls, therefore resulting in a slight debit to the trader. The debit is the maximum risk on the trade. A closer look will show why and how. Should the trader's bullish sense be incorrect, and you may not believe it, but a trader being wrong about the market direction has been known to happen, and the market forms a bearish trend, all options, long and short, will expire worthless, resulting in a loss of the premium paid. Let's assume that the premium paid was 4 points and that the market expiration was trading below the 1025 level. 1. The 1075 long call expires out of the money and worthless. 2. The 2 short 1050 calls expire out of the money and worthless. 3. The 1025 long call expires out of the money and worthless. 4. Total premium paid at inception is 4 points. 5. Total value of the spread at expiration is 0. 6. Total loss on the trade, 4 points, or $1,000. 4 times $250 equals $1,000, excluding fees. The same risk profile also applies if the market roars up above the butterfly and surpasses the trader's expectations. Here too, the maximum loss possible is confined to the initial debit. Let's look at some numbers and scenarios and understand how it works and how the strategy behaves if it is becoming fully in the money at expiration. For the sake of these examples, let's assume a hypothetical initial debit of 4 points. Scenario number 1, market is at 1075 at expiration. 1. The long 1075 call expires at the money with an intrinsic value of 0. 2. The 1050 call expires in the money with an intrinsic value of 25 points each, that's minus 50. 3. The long 1025 call expires in the money with an intrinsic value of 50 points, that's plus 50. 4. Total value of the butterfly at expiration is 0. 5. Total premium paid at inception, 4 points. 6. Total loss on the butterfly, 4 points or $1,000. 4 times $250 equals $1,000, excluding fees. Scenario 2. Market is at 1100 at expiration. 1. The long 1075 call expires in the money with an intrinsic value of 25 points. 2. The short 1050 calls expires with an intrinsic value of 50 points each, that's 100. 3. The long 1025 call expires in the money with an intrinsic value of 75 points. 4. Total value of the butterfly at expiration is 0. 5. Total premium paid at inception, 4 points. 6. Total loss on the butterfly, 4 points, $1,000. 4 times $250 equals $1,000, excluding fees. It comes down to the fact that no matter where the market is at expiration, if it is trading below the long 1025 call or above the long 1075 call, the value of the position is always 0. and thus represents a loss that is limited to the 4 points or any other initial sum that was the original debit. The same is true for any other strike prices, and for a call butterfly and a put butterfly as well, as long as the distance between each of the long options, the wings, to the short options, the center, is equal. Any expiration outside the borders of the butterfly will result in the same outcome. With the risk profile outlined, let's consider the profit potential of the strategy. Similar to the iron butterfly, the directional butterfly holds the promise of great return should all parts fall into place. Ideally, in our specific example above, the market will trade at 10.50 at expiration. Again, for the practical reasons I mentioned above, a trader would most likely not remain in the trade to this point. But there are always exceptions, and though not probable, it is possible. At the 10.50 level, the trade would look as follows. 1. The long 10.75 call expires out of the money with an intrinsic value of 0. 2. Short 10.50 call expires at the money with an intrinsic value of 0. 3. The long 10.25 call expires in the money with an intrinsic value of 25 points. 4. Total value of the butterfly at expiration, 25 points. 5. Total premium paid at inception, 4 points. 6. Total profit on the trade, 21 points. 25 minus 4 equals 21, or $5,250, excluding fees. Since the risk on the trade is a mere 4 points, worst case scenario, the margin requirement is low as well, several $100s. For such low margin and relatively low risk, a profile potential of 21 points is a nice windfall. Furthermore, if profit may be valued based on the return on margin, then significant profits will appear even at other points of expiration. We'll take a look at our break-even points, and from there deduce and draw a graph of profitability. The break-even points are determined by the amount of premium paid at the inception of the trade. In this case, the premium paid was 4 points, and therefore the break-even points excluding fees are 1029, 1025 plus 4, and 1071, 1075 minus 4. Between these 2 points, we can find a profit graph with a bell curve shape. Its basis points at 1029 and 1071, and its peak at 1050. Let's talk about the probability of winning. As you can see, the directional butterfly is very attractive in terms of its risk-reward profile. Its Achilles heel, however, is the probability factor. We're not sure butterflies have heels, but if they do, they'd better watch out for that probability factor. As the examples demonstrate, there's a very specific range in which the structure is profitable. The range may be narrow or wide. Nonetheless, the need to be correct, not only about market direction, but also about a specific range for the market to trade in, and within a specific time frame, makes picking a winning trade a tough task. To increase the probability of a win, it is possible to create a butterfly with a wider range. Luckily, creating a butterfly with a wider range has nothing to do with genetic engineering. One way to widen the range is simply increase the distance between the center options and the wings. In the example above, this range was 25 points, 1025 to 1050, and 1050 to 1075. A trader can create a 30-point range by selecting the following strikes, 1020, 1050, 1050 to 1080. As in any other trading strategy, here too there is a give and take to any variation on the trade. The advantage of a wider range is the higher probability that at expiration the market will expire within that range. The giveaway here is in the initial premium you have to pay. The wider the range, the more expensive the structure. Since the risk in the trade is always the initial debit, by increasing this amount, you are ultimately increasing your risk. The stretched butterfly. There is another technique one may employ in order to widen the range of the butterfly without making the cost basis prohibitively expensive. While utilizing this method does indeed increase the initial cost, it is often more cost-effective than widening the original directional butterfly. The specific structure is often referred to as the stretched butterfly. Is there anything left to do to a butterfly? Fortunately for these harmless creatures, the answer is no. The name of the structure points to this nature. The specific variation entails stretching the center options and selling them at 2 different strike prices, rather than at the same strike price. Again, a stretched butterfly consists of 4 options, all of the same type. All calls or all puts. It also consists of wings and center options. Where it differs from the original directional butterfly is in the distance between the individual options. While the original structure entails selling 2 center options at the same strike price, the stretched version involves the sale of 2 center options at different strike prices and buying the final long option farther away. Once again, you can see an illustration of the structures on our website, theoptionsacademy.com. A close look at the original butterfly will show that essentially it is comprised of a long call spread, the 1025 by 1050, and a short call spread, the 1050 by 1075. The stretched butterfly simply takes this format and creates a long call spread, 1025 by 1050, and a short call spread, 1075 by 1100. Since the short call spread is sold 25 points further away, i.e. the 1075 by 1100 call spread is sold instead of the 1050 by 1075 call spread, it brings less premium into the equation, which results in a larger debit. For the purpose of our example, let's assume that the debit now is 6 points instead of 4 points. The compensation for the cost, however, comes in the form of increasing the winning range by 21 points, or approximately 50%, while the overall range for the original butterfly is from 1029 strike price to the 1071 strike price, a range of 42 points. The stretched butterfly boasts an overall range of 63 points, from the 1031 strike price to the 1094 strike price. The stretched butterfly concludes our butterfly's presentation, and just in case you were wondering, there are no Caterpillar option strategies. Lucky for you, or we'd be forced into making some sort of joke at the end about wrapping up the caterpillar. To recap the main points, the butterfly strategy is a limited, predetermined risk stratagem. In its basic form, it offers a fantastic risk-reward profile to its users. This great risk-reward profile is hampered only by the relatively low probability for a win. Option sellers who seek to collect large premium sums while limiting their risks utilize the iron butterfly. Option buyers who attempt to identify direction and movement range in a specific market implement the directional long butterfly. Both structures are favorite of many traders who want to enjoy limited, built-in, and predetermined risks with the potential for high profit. Here is to your success, and remember, there is substantial risk of loss in trading futures options. Remember that past performance is not necessarily indicative of future results, and remember that only risk capital should be used. We hope to see you soon.